Hello, my name is Avi, and I am the head of acquisitions and co-founder at Seller Edge Capital. And today I'm here to talk about the pricing process and what Seller Edge Capital is looking for when reviewing and analyzing seller finance business notes for acquisition. At Seller Edge, we are targeting several different types of characteristics. We have a primary list and then a secondary list. The primary list is the must-haves. These are the must-haves that it takes to get a note sold or to get a note purchased in the secondary market. The like-to-haves are the characteristics that will determine how much a note is sold for. The primaries will determine if the note can be sold at all. So let's dive in. So first on our primary list, the very first characteristic that we look at is equity. Equity plays a huge role when pricing notes for acquisition. Equity is the cash down payment that the buyer provided at the time of sale. Seller Edge is targeting a 20% equity position. This equity position should be non-borrowed capital, meaning the buyer should not go out and borrow the down payment to give to the seller. It should be monies that the buyer has in a IRA fund or self-directed IRA, a bank account, some sort of money market, but they should not be using leverage to get that down payment. If they do that, it risks bumping the note from a first lien to a second lien, which can drastically reduce the value of the note. The second characteristic that we look for is a minimum of $100,000 principal balance. So we are targeting notes with a $100,000 principal balance all the way up. So as long as the note and the note's remaining balance is $100,000 or more, Seller Edge will be more than happy to look at it for acquisition. The third characteristic that Seller Edge looks for is recourse. Recourse is a borrower or a guarantor that is personally guaranteeing the loan if the buyer of the business is a corporation. So in other words, if a person is selling a business and a corporation steps in to purchase it, you want to make sure as a seller that you are asking the corporation buying it that a human being with a social security number steps in and personally guarantees the loan in the case that the corporation is unable or unwilling to make that payment. This is called recourse. It is very important. It is a must-have when selling a business note. That actually leads me to the fourth characteristic, which is credit score. So in some very rare cases, we will see a buyer use their personal name to buy a business. So obviously we're going to look at the buyer or the borrower's credit score. But in the case of a corporation with a personal guarantee, we're going to look at the guarantor's credit score. Seller Edge is targeting a credit score of 650 or higher. 650 is a very mid-average credit score in the American credit landscape. So it's nothing controversial. This is a very average credit score. We're not looking for perfect credit, and we most certainly cannot take extremely poor credit. We're looking for middle average or higher. So that actually covers our primary characteristics there. So those are the must-haves. Now, these are the like-to-haves. I will say, before we jump into the like-to-haves, that Seller Edge is targeting all businesses in all states, in all jurisdictions. So we are not excluding any types of businesses. This goes for asset-heavy businesses. This also includes asset-light businesses. This could be any kind of business really that's sold. We are very interested in reviewing any kind of note secured by any kind of business. So just get that out of the way, and we'll move on to the like-to-haves or the secondary list that we are targeting. And that would be number one on that secondary list would be amortization. So typically a business loan will amortize fully principal and interest from a 36-month to a 7-year amortization. That is typical. That is what we're primarily and ideally targeting. Now, we know that the world is not perfect, and we know not every single note that we see is going to be 3 to 7 years, fully amortized with no balloons. So we absolutely positively are looking at amortizations longer than 7 years, and we'll most certainly look at amortizations shorter than 3 years. I will say that if you go above that 7-year process, it's going to be very difficult for us to buy the whole loan at once because of the risk profile, but we can absolutely provide capital solutions that will allow us to take bite-sized portions of the loan if it exceeds that 7-year amortization. And in addition to that, we can also look at interest only. We can look at balloon payments. So we are very flexible on that amortization structure. The second item on the secondary list is the rate, the interest rate baked into the seller finance business note. So typically, SellerEdge is targeting business notes with high single-digit interest rates to low double-digit. Now, we are not married to this. So we can look at a note with a 0% interest rate. We can look at a note with a 15% interest rate, assuming it does not violate usury laws in the state and jurisdiction in which that note exists. That being said, we can back our yield into any type of rate environment or rate that we have in the asset. And so we're very flexible there as well. The third item is about security, and specifically UCC, that also stands for Uniform Commercial Code Financing Statement. This is a security instrument used and filed with the Secretary of State, used on commercial transactions such as small businesses and commercial properties. It is very important for the lender, or in this particular case, seller financed seller or note holder, to tether the obligation to a security instrument. So to telegraph to the world that they are in line to get paid, so to speak. It acts just like a mortgage in so many words, but a UCC is very important. It basically acts as a security instrument. Now, in addition to the UCC, we also are targeting documentation referred to as security agreement. Now, we hear often in the space that if you have a UCC, you don't need a security agreement. Technically, that's true, but it's not the best structure. When using a UCC, there should always be a UCC and a security agreement. That is going to tighten up the language. It's going to tighten up the repossession process or a default, and it's going to just hammer home your security position as a note holder. So very important. SellerEdge is targeting notes that do have both UCC and security agreements. We give preference to those notes, and we reflect that preference in the pricing that we submit. If there is no security agreement and just a UCC, we can look at it. If there's just a security agreement and no UCC, we can look at that too. But if there's no security agreement and no UCC, we'll take a look at it, but it's going to get a little choppy with regards to maximum value and pricing. So I hope this has been helpful. I will say, again, we are operating in all 50 states, all jurisdictions, all business types. We welcome you to submit your note, and we look forward to serving you in the process.